I'm Howard Klein, and I run a boutique advisory firm called RK Equity. And first time ever that I spoke anywhere publicly was at this conference in 2016 or 17, I think. So anyway, thank you one-to-one for having me back to speak, and then to moderate a great panel with many of my lithium friends. I've been telling lithium equity stories for 14 years, mostly through the prism of rock music and pop culture. After the almost famous Lithium 2.0 period from 2016 to 2018, we're now in the roaring 2020s. Lithium Rush 3.0. Today's installment will revive a narrative I started in 2018, comparing Tier 1 producer Livent to the Oscar-winning Rocky franchise. Spun out of FMC, Survivor Livent, led by CEO Paul Graves' Eye of the Tiger, is now hitting its stride, with an agreed merger of equals with peer AllChem to create a $10 billion plus market cap, globally diversified lithium pure play. The 5-year period since Livent's IPO have been like Rocky 1 and Rocky 2. Livent is now entering its Rocky 3 phase, from which I predict it will be well positioned to take down the biggest Rocky 4 challenge, a supersized China Drago. Before discussing Livent, I'll say a few words of update since I spoke here last October. A few weeks after that October 6 one-to-one presentation, in which I said lithium was bound for glory, using the Tedeschi trucks, for those who know that band, the spot China lithium price peaked, and it began a 70% drop over the next 5 months. In March, my partner Rodney Hooper and I interviewed Matt Fernley to discuss their shared prediction that the free-falling lithium price should bottom in a few weeks and be followed by a sharp bounce. The China spot lithium carbonate price has now rallied 70% in the last 5 weeks. As an aside, I'd encourage all of you in the audience and those viewers who will be watching this presentation on YouTube shortly to register your email at rkequity.com and follow me on Twitter at Lithium Ion Bull and subscribe to Rockstock channel on YouTube. And please remember, I'm not a financial advisor, and nothing I say in this presentation is financial advice. To keep myself honest, I have updated this table from October's presentation, which highlighted that life in lithium and iron ore has been much better than old gold, copper, and other metals. But gold proxy ETF GDX is up 25% since then, while lithium proxies Albemarle and SQM are down more than 20%. So, is gold the new lithium? I don't think so. My lithium song remains the same. Buy the dip. All-time higher love is coming. Lithium, and in particular the precursor mine spodumene, remains, as Elon Musk has pointed out, the new software. My partner Rodney has not changed his thesis that a structural deficit in lithium is here to stay as far as the eye can see. Recent price falls are due largely to one-off destocking in China, which is largely seasonal in nature, and was exacerbated by a buildup last year in cathode and cell capacity in anticipation of a lapsing of certain subsidies for EVs. I'd encourage you to watch Rodney's widely viewed presentation at last month's one-to-one conference in London for this broader discussion, and point you as well to Rodney banging the drum that upside surprises to lithium demand are likely from the hyper-growth in the often underestimated segment, energy storage, which we recently discussed with Iola Hughes of consultancy Row Motion. In 2019, Rodney and I augmented the Lithium Ion Bull newsletter I've written since 2015 with our podcast, Lithium Ion Rocks. Our first episode, and our most repeated mantra when thinking about lithium investment opportunities, takes inspiration from KISS. Keep it simple, stupid. Those following these guiding principles have generated enormous wealth over the past few years. Commodity equities follow commodity prices. Go long what Tesla is short. Go long what China is short. Chris Ellison, the billionaire founder of Mineral Resources, which has a partnership, joint venture with Albemarle in Australia, has famously said, if you own your own rock, you're God. Otherwise, you're screwed. By us. With the Biden administration's acceleration of policies supportive both of electric vehicles and ex-China critical mineral sourcing, it is my opinion that if you own your own North American spodumene rock, you're God. KISS, Rocky Lithium. KISS, spodumene software. The volatile China spot lithium price often influences short-term sentiment and equity market prices, which makes it harder to raise equity for lithium development stories, which serves to slow development and hence feed our structural deficit thesis. But strategics across the supply chain, namely auto and battery OEMs, who must take a long-term view of how they can supply their huge downstream investments with upstream raw materials, have been making more substantive investments and supply agreements with key producers and near-term producers. In January, Tesla replaced a low fixed-price spodumene offtake with Piedmont Lithium to market-based pricing at much higher prices. GM then announced a $650 million investment in Lithium Americas for development of the $2.3 billion Thacker Pass project. LG Chem then invested $75 million in Piedmont. Tesla broke ground at Corpus Christi, Texas, focused on 40,000 to 50,000 tons of lithium hydroxide for its most sexy vehicles, in addition to the Cybertruck and Semi. This is like Fordlandia. They don't yet own the mines, but vertically integrating all the way down to processed material is what auto OEMs are going to increasingly have to do. Ford signed 5 substantial lithium supply deals with Albemarle, Nemaska, SQM, Compass, Energy Source Minerals as part of a major capital markets day they had a few weeks ago. Albemarle has bid $3.5 billion for a pre-producing spodumene company, Liontown, a bid which has been rejected as too low. Liontown stock price today is materially higher than Albemarle's $2.50 bid. Market seems to think another bid is coming, or a higher bid from Albemarle. Albemarle also announced $1.5 billion of investment in South Carolina, a megaflex plant which targets 100,000 tons of hydroxide capacity in coming years. And Livent and AllChem agreed a friendly merger of equals, creating the number 3 largest producer globally. I've often used AllChem and its predecessor Orocobre to articulate how the often 30, 50, and 70% retracements in quality lithium equities present by the dip gifts. From its 2007 IPO around 20 cents and 25 million market cap, AllChem has explored, developed, permitted, financed, and began producing lithium 6 years ago from conventional brine operation in Argentina. A few years ago, it merged with Galaxy Resources, another Lithium 1.0 success story, which provided the merged AllChem experience with spodumene rock. AllChem's little lithium engine that could is now merging with Livent at an all-time higher love price. It is a testament to AllChem's success over 15 years that its shareholders will receive 56% of the merged company, while 80-year-old Livent, which has higher production and generally produces lithium to higher quality specifications than AllChem, will receive 44%. Rodney and I have recently been taking advantage of changes Elon Musk has made to Twitter, in particular through Sunday morning live discussions on Twitter Spaces. I discussed last month's Livent's rocky history since IPO and some strategic mistakes made by its CEO, Paul Graves. But it is my strong opinion that the Livent-AllChem merger is a masterstroke that will be Paul's legacy. You can listen to this May 14th Twitter Spaces through my Twitter handle or the repurposed segment we recently published as a Lithium Ion Rocks podcast, available on Spotify and Apple Podcasts. My biggest strategic takeaway is summed up in this Bloomberg quote from Livent CEO Paul Graves. America-centric is a big differentiator for us with customers, with investors. China, where U.S.-based Livent has refineries, will not be a focus of growth for us in the future. The growth area is really investing in Argentina, investing in Canada, investing in localized Western supply chains, Graves said. IRA-compliant lithium chemicals is key, as big money Biden has supercharged America's positioning in the battery arms race. Livent and AllChem today produce and sell some 35,000 tons of lithium chemicals and about 150,000 tons of spodumene. By 2027, they expect lithium chemical capacity of nearly 250,000 tons. To put this number in perspective, 250,000 tons is larger than the entire battery-grade lithium market was just a few years ago. Like many, I was surprised to hear of this merger, despite the obvious strategic logic, because I thought either Livent and or AllChem would more likely get bought by a company like Rio Tinto, who has been active developing its own lithium assets and bought a challenge lithium brine project, Rincon, last year for over $800 million. Never underestimate big mining to continue to make strategic mistakes. The talk on Wall Street, buy and sell side, was that both Livent and AllChem were too small for big mining. But post-merger, now they'll be ripe for a Rio-like bid. Lithium will likely experience in the next few years a Rio Alcan Moment, a time when big mining, having waited too long, will miscalculate and overpay for growth at a market top. And that will be the moment into which I will be selling most of my lithium equity exposure. I am very happy to see this deal between two chemical companies, an intra-lithium industry consolidation. It means we will hear from Paul Graves, the silver tongue from Goldman Sachs, hopefully for many years to come. Paul is the most articulate commentator about lithium market dynamics relative to his peers, in my opinion. Argentina risk, which we'll talk a bit more about on the next panel, is not to be dismissed when thinking about lithium equity exposure. Merging Livent and AllChem could make the company too big to fail, providing some protection against potential profit-grabbing policies that might be considered in the future. Unlike many of its peers, Livent and AllChem have majority control of all their assets and are largely vertically integrated from raw material precursor to final chemical production. Livent AllChem is a globally diversified industrial company in the sexiest specialty chemicals niche, growing at 5 to 10 times GDP growth. It deserves to trade at a higher EV to EBITDA multiple than traditional cyclical miners. I see valuation uplift from AllChem's perspective, as its assets will now trade for the first time within the full NYSE listed company that is Livent. And by keeping the ASX listing, Australian holders will now have exposure to Livent's world-class assets in Argentina and a more advanced spodumene to hydroxide strategy in the hottest growth area in lithium, Quebec. Livent's historic focus on high-performance lithium hydroxide left it notoriously short its own carbonate, which forced it to buy third-party carbonate at often inopportune times. AllChem's carbonate solves this problem for the merged entity, which should ensure higher quality and more predictable earnings, thus justifying a higher EV to EBITDA multiple. With the number 6 and 4 producers consolidating into number 3, the oligopoly that is lithium, in particular those qualified with Livent's Tier 1 customers like Tesla, Ford, GM, and BMW, will retain pricing power and strong software-like margins. The $10.6 billion merger against last year's $1.2 billion of EBITDA equates to a valuation of just 8.8 times trailing EBITDA, considerably less than the 14.4 times Albemarle paid for Rockwood in 2014, and the 17 times Rockwood paid for Talison in 2013. For these reasons, I'm very bullish that Livent plus AllChem will be an accretive 1 + 1 = 3 style merger. In the same way, the merger of Orocobre and Galaxy was accretive to both companies' shareholders. And the merger will accelerate the development of the North American Lithium Triangle, from Carolina to Quebec to Ontario. This spodumene to hydroxide triangle is first among equals, in my opinion, when thinking of developing a secure, scalable, sustainable, strategic supply chain for North America. And Quebec is first among equals within the North American Lithium Triangle. Sayona and Piedmont are starting up the twice-failed North American lithium operation, which will be followed soon by Livent's permitted Nemaska, now partnered with Ford, and the future integration with AllChem's partially permitted James Bay mine. In a stroke, the Livent-AllChem merger positions the company to lead the likely consolidation of Canada's spodumene rocks. Rocky Quebec, Survivor Livent, Eye of the Tiger. In my opinion, Mr. Market gave zero value for Nemaska inside Livent and gave zero value for James Bay inside AllChem. They are lithium freebirds, to draw from Leonard Skinner. Considering the growing valuations of pre-producers in Quebec on RK Equity's lithium scoreboard, I see substantial valuation uplift inside Livent-AllChem from their critical Canadian rocks. Substantial cash flows from 60% plus software margins will ensure non-dilutive financing for what could be 60 to 75,000 tons of hydroxide production in coming years from Quebec. Rocky Quebec should also draw strategic attention to the deeply discounted valuation of critical elements, the next spodumene cab off the rank, permitted and primed for partnership. I'd like to flag this interview with Sarah Marisol from RK Equity's first ever conference in March, Canada Rocks. Sarah recently left Tesla's procurement team after 5 years to move to Montreal and Livent. Her prime focus is on the development of Quebec, a key growth driver for the combined company. Again, go long what Tesla is short: spodumene software. I suggested ahead of Philadelphia-based Livent's 2018 IPO that the underdog Rocky would emulate the theme song from Rocky 1, Gonna Fly Now. The $17 IPO cratered through the COVID trough around $3. I don't always get it right. Livent's profitability and stock price has since recovered to $25, a respectable 50% above its IPO price over 5 years. As the spot lithium price has now bottomed and sharply bounced, and with my partner Rodney and major investment banks and research providers I respect like Canaccord, Macquarie, and Morningstar predicting stronger for longer pricing well above the cost curve throughout this decade, I again believe LTHM is going to fly now. Before I conclude, I'd like to highlight this chart taken from newly renamed Champion Electric Metals, which took inspiration from Livent for its new ticker on the Canadian Stock Exchange, LTHM.CN. Lithium equities, spodumene exploration stories in particular, tend to follow this typical Pierre Lassonde life cycle curve. When the backdrop for any commodity like spodumene is hot, new discoveries can result in parabolic stock price rises, like Robert Friedland's big score in Voisey's Bay, for those old enough to remember. Focused on Rocky Quebec, Champion Electric Metals is one of my newest investments and is a new RK Equity client. I have known the CEO, Jonathan Buick, for 15 years and have been impressed with the board of proven lithium executives he's assembled, which have invested nearly $2 million in personal capital into the company in recent months. Again, not financial advice, please do your own research. But with a large acreage position in between Unicorn, Patriot Battery Metals, and following Winsom's 10x plus rise to nearly $300 million market value, I am hoping Champion, which is closing on an additional $4 million equity raise this week, will have similar success with early drilling and could achieve continued market recognition well above its current $25 million market value. This is a list of all companies RK Equity has represented in the lithium battery materials space over the past 14 years. And this is a disclaimer of all the companies we advise and/or hold equity positions in. To be clear, again, RK Equity is not an investment advisor, and nothing I've said here should be considered investment advice. They're just my opinions, but I would highly, highly recommend that you do your own research, as I expect many of the companies that have grown 10 to 20 times and have become unicorns may still triple or quadruple in coming years. And other earlier stage companies like Champion Electric Metals may follow their pioneering brethren and grow from 25 million to $1 billion during the same time frame. Thanks again to 1 for having me speak,